how much worse can home prices actually get? If you're a first-time homebuyer in the United States, the reality is already grim. The median age of someone buying their first home is now creeping toward 40, a staggering number that excludes all those who may never be able to afford a house at all. Mortgages with just 1% down are becoming increasingly common, and 40-year loan terms are no longer unheard of. For the average family, this means that nearly 40% of their monthly income must go toward their mortgage alone, even before considering taxes, insurance, and maintenance. In certain cities, this figure skyrockets above 90%, effectively locking out families from the market entirely. It's clear that affordability has become a crisis, and understanding why requires looking beyond just the price tag of a home. Today, we'll explore the current state of the American housing market, compare it to other countries, and break down the factors that could make home prices soar even further in the coming years. At first glance, there appears to be a silver lining. Over the last 3 years, the median sales price for homes in the U.S. has trended slightly downward from its all-time peak in 2022. This might suggest that building initiatives and housing policies aimed at improving affordability are finally starting to work. But this is where the data can be misleading. The median sales price only reflects the homes that actually sell, not the full spectrum of properties on the market. In reality, nearly 25% fewer homes are being sold each month compared to pre-pandemic levels, and the number is almost 40% lower than it was just 4 years ago. The explanation is simple: homeowners who locked in mortgage rates below 3% are reluctant to sell, even if they want to move to a different city. Many of them are choosing instead to rent out their homes while renting another property elsewhere. Meanwhile, the homes that are being sold tend to be more affordable, starter properties that skew the data. So, while median prices may appear to be stabilizing or even decreasing slightly, this is a misleading picture. True affordability is still declining for the average family trying to enter the market for the first time. When it comes to housing affordability, the US actually fares better than many other high-income countries, but that doesn't mean there isn't room for the crisis to worsen. The average house price-to-income ratio in America currently sits around 3.4, which essentially means that a family would need to work 3.4 years of their after-tax income to afford an average home. By comparison, in countries like the UK, this ratio is 8.7, in Australia, it's 8.4, and in Canada, it's 9.5. These numbers suggest that, if American home prices were to rise to match the ratios of these countries, the median house could easily double or even triple in cost. The reasons for this disparity go beyond income levels. They also include differences in home sizes, cultural norms around shared housing, and urban planning strategies. For example, homes in the US are generally larger than those in other countries. When you adjust for square footage, American homes still cost less per unit of space, but Americans typically prefer more rooms and larger houses, which drives up overall costs. Even if we scaled back and built smaller, more efficient homes, other structural factors in the housing market could push prices even higher. Another major factor influencing housing affordability is urban concentration. The US benefits from a relatively spread-out population compared to countries like Australia or the UK. Only about 7% of Americans live in the New York metropolitan area, and even when combining the 10 largest cities, less than a quarter of the population is concentrated in major urban centers. This dispersal has historically prevented extreme price inflation in one location. However, as industries like tech and finance consolidate in major cities, certain metropolitan areas are seeing prices far outpace the rest of the country. This creates a ripple effect. High-income professionals cluster in these cities, driving local demand, while those unable to compete for housing look elsewhere, often renting their original home to others in the process. This rent-vesting phenomenon allows property owners to hold on to low-interest mortgages while continuing to participate in the housing market, further constraining inventory. Over time, this concentration of opportunity and wealth in a few cities could lead to price pressures similar to those seen in Sydney, Vancouver, and London, where even middle-income earners struggle to find housing without committing decades of their income. While the US is currently facing serious affordability issues, some global cities provide a sobering look at just how extreme the problem can get. In Sydney, the average two-bedroom apartment costs more than 12 times the average disposable income of local residents. In Hong Kong, Shanghai, and Seoul, the situation is even more severe. Some families must dedicate more than 30 years of their total take-home income to purchase a modest apartment. These homes are often tiny, ranging from just 170 to 300 square feet per person, and require multiple generations to pool resources just to make the purchase feasible. While cultural norms may support multi-generational living, in these cases it's driven by necessity rather than tradition. For perspective, the average American enjoys roughly 900 square feet per person in their home, and many families can still maintain multiple bedrooms per household. This stark contrast demonstrates that even the challenging US housing market could become far more severe if structural pressures like limited construction, rising interest rates, and urban concentration intensify over time. The takeaway here is clear: there is no natural limit to unaffordability. Without proactive policies addressing housing construction, responsible lending, and urban development, there is nothing to prevent American home prices from trending toward the extreme scenarios we see in other countries. In fact, signs are already emerging. For the first time in over 160 years, the average number of people living in a US household has increased, despite declining birth rates, because multiple generations are sharing homes out of necessity. At the same time, the average size of newly constructed homes has begun to shrink for the first time in decades. While one might hope this trend reflects a newfound closeness within families or growing environmental consciousness, the reality is far less optimistic. It's being driven by economic pressure. The American housing market, though better off than many international peers, is not immune to the forces that have created extreme unaffordability elsewhere. So, what can we take away from all of this? The US housing market is in a precarious position, and while affordability hasn't reached the extreme seen in Sydney, Hong Kong, or Vancouver, the underlying factors driving the crisis, urban concentration, rising demand in key industries, stagnating wages, and restrictive construction, could push prices far higher in the years ahead. If you want to stay ahead of these trends, it's critical to understand not just the numbers, but the social, economic, and policy forces shaping the market. If you found this video helpful, hit the like button, subscribe, and turn on notifications so you can keep learning how money works. Next, check out our video on why most policies designed to reverse the housing crisis often make it worse, because understanding the system is the first step toward protecting yourself.